The secret is out. Warren Buffett has been able to double the average stock market return for the last 55 years, and now we're going to be going over his secrets and how he was able to get an average 20% return a year for the last 55 years. What's up everybody, I am Jaspreet Singh from theminoritymindset.com, where money minds rethink rich. Between 1965 and 2020, Warren Buffett's investments grew by an average of 20% a year, while the stock market in general grew by just 10% a year. It's hard to imagine what a 20% return a year really means. I mean, it sounds like a really good return, but what does that really translate to in dollars? So let's take a look at this. If you just invested $100 a month and you can get a 20% average return a year, and you do this for 55 years. So this is what Warren Buffett did. An average 20% return a year for 55 years between 1965 and 2020. If you do this and you just invest $100 a month, you will have, after these 55 years, $165 million with your $100 monthly investment. When I did this calculation myself, I almost couldn't believe it. I hit the refresh button multiple times on the calculator, and I'll show you on the screen, because you are turning this $100 monthly investment, which is right around $66,000, which you are investing over the 55 years, but because you can get a 20% annual return, you were able to turn the $66,000 into $165 million. Now, I know what you might be thinking, but Jaspreet, $100 a month back in 1965 is worth way more than $100 today. You're right. $100 back in 1965 is worth probably something like $800 or $900 a month today. But even if you can't invest $800 or $900 a month today, just cut these numbers in half or a fourth or even a tenth, and it's still pretty crazy. So now the question is, how in the world was Warren Buffett able to get this consistent 20% return a year every year over 55 years? Well, that's what I'm going to be talking about in this video. We're going to be breaking down his secrets, but before we get into that, I need you to do me a quick favor and smash that thumbs up button below. And if you have not already, be sure to join our free Discord community called the Guac Talk channel, because as we all know, extra guac is truly a symbol of extra wealth, and in this Discord server, you can chat with other minority mindset thinkers. You can chat about the stock market, the real estate market, the cryptocurrency market, and all things building wealth. This community is completely free, and you can use this community to chat with and network with other minority mindset thinkers. So if you want to join our brand new free Discord server, I'll put the link to how you can do that in the description below. So the reason why I'm talking about Warren Buffett's returns is because Warren Buffett, in the last Berkshire Hathaway meeting, he came out and he put out a letter where he showed the S&P 500's average returns over the last 55 years, and that was right around 10-point-some% a year. And then he compared that to his company's returns over the last 55 years. And the Berkshire Hathaway, his investments, his company got an average of 20% returns a year over the last 55 years. But the thing that you have to understand about this is that even though he got an average of 20% a year return, that doesn't mean that his investments went up every single year. Some years he lost money, other years he made a lot of money. Yahoo Finance did a write-up on this, and what they said was, quote, long-term overperformance comes with many years of underperformance. So over the years, he had some big winners, he had some big losers, but on average, his money grew by 20% a year. But what's interesting is what Warren Buffett says about average returns, because what he says is that there's no such thing as average returns in the market. Neither Berkshire nor the S&P saw many years where they delivered an average return. Many years saw either massive gains or very disappointing performance. Average almost never happens in markets. A lot of times we look at successful investors like Warren Buffett as these people who are just able to pick the perfect stock, who are able to find the right stock, and everything they touch turns to gold. But that isn't always the case. I mean, Warren Buffett had his fair share of losers that lost him a lot of money. One of his massive mistakes, PCC. He bought the entire company for $37 billion, and then he said, quote, I paid too much for the company. I believe I was right in concluding that PCC would over time earn good returns, but I was wrong in judging the average amount of future earnings, and because of that I paid way too much for the business, and that resulted in almost a $10 billion loss. So now the question is, what did he do to get these crazy returns, and how can you start implementing some of these things into your own investment strategy? There are 5 things that I want to talk about that Warren Buffett does when he invests his money, and these are also recommendations that he gives other people successful when he helps people invest their money. So some of these things I got from reading his biography called The Snowball, great book about Warren Buffett, by the way, and also some of these things are from an interview that Warren Buffett did with CNBC. They are understanding the value of a company, understanding the moat, ignoring the chatter, thinking of stocks like a farm, and keeping your costs low. Let's start by talking about number one, value. When you go and you invest in a company on the stock market, you are investing into a business. You are buying a little piece of ownership into a business. And so what you want to understand is, are you overpaying for the business? Are you underpaying, or are you getting a good value for your business? And there's more than one way that you can value a company. The most common way to value a company is by looking at its earnings. So this is kind of like what you see happen on Shark Tank. You go into Shark Tank and you have a company that's making a profit of $100,000 a year, and then you go and you say that you're valuing your company for $1 million. If you're making $100,000 a year and you value your company at $1 million, that means you're valuing your company at 10 times earnings, because you're making $100,000, you're valuing it at $1 million. So 100,000 times 10 is $1 million, so you're valuing your company at 10 times earnings. That's one way that you can value a company. A second way that you can value a company is by looking at the underlying assets, and then you just value these assets. So going back to the same example as before, where you have this company that's making $100,000 a year, but now this company that's making $100,000 a year also owns the building where they operate. And this building, let's just say, is worth $500,000. And you also own some machinery, and you also own some other products, some other things in your warehouse. And all these assets, if I came in and I sold them tomorrow, I could get $1.2 million. So on the earnings, you might be valuing the company at $1 million because you're selling it for 10 times earnings, but somebody else might look at your company a little bit differently. They're gonna look at your real estate, they're gonna look at your machinery, and they're gonna say, yeah, you know what? Your hard assets are actually worth more than your business itself. The business that you're running isn't as profitable as the assets that you own, so I might come in, buy the company, and then just sell off the assets. If you've ever heard of corporate raiders, this is exactly what they would do. They would try to buy as many shares of the company as possible. That way they could get the majority share of ownership. That way they can make decisions on how to run the company. And as soon as they do that, then they will liquidate all the assets. They will sell the assets of the business, and then they will let the business go to waste because the assets are worth more than the underlying business. So that allows you to come in, buy a business for $1 million, and then sell all the assets for $1.2 million, and then you get to walk away with the cash. What Warren Buffett does when we talk about value is he creates his own valuations of companies. He looks at everything that a company has. He looks at what a company does, he looks at who the executives are, he looks at what type of products you create, and then he compares you to other competitors. He looks at the numbers, he sees how much money you're generating, he sees what your expenses are, he sees what your profits are, and then he creates his own value figure, and then based off of that, he's gonna look for companies that he believes are undervalued, because he believes that this company has a great product, that you're selling something great that people love, that people want to own. And even though you have a great product, he believes that based off of the current stock price, your company is undervalued. So this is an analysis that he does. He's looking at these financial statements all day long, trying to analyze the company's numbers, because he wants to know how much money are you making and what is your company actually worth. If your company is selling for a price lower than what he believes the company is actually worth, he will own it and own it for a long time. Second, he will look at a company's moat. So what a moat is how hard is it for a competitor to come in and take a company's spot. So this really goes back to medieval times. If you remember, back in medieval times, you might have a castle like this, and if you have a small moat around your castle, well then enemies will have an easier time coming into your castle and they can attack you. But if you have a castle and this castle has a huge moat around it, and now you got alligators in there and you have cannons over here, then it's going to be a lot harder for an enemy to cross this because your moat is a whole lot larger. So what Warren Buffett is trying to do is not think of the medieval wars. He's trying to think of what companies have a large moat around them, making it very hard for a competitor to come in and kick out this company's position. An easy way to really understand this is just to think of a company like Coca-Cola. Warren Buffett loves Coca-Cola, and one of the reasons why is that he believes they have a large moat. People love Coca-Cola, hate it or love it, that is the reality of the world that we live in. And people will be willing to buy Coca-Cola for $2 a bottle, even if you put up a competitor of Coca-Cola right next to it and you sell it for 50 cents. People will still be drawn to Coca-Cola because they love the brand of Coca-Cola. Not just that, Coca-Cola has huge contracts with companies all around the world. They have contracts with movie theaters and restaurants and hotels that would they have to sell nothing else except Coca-Cola. So now if you go out and you try to create a competitor to Coca-Cola, you can do that, but you're gonna have to fight this big moat that Coca-Cola has because one, people love the brand Coca-Cola, and second, now you're gonna have to go to these restaurants, you're gonna have to go to these movie theaters, you're gonna have to go to these companies and try to get them to cancel these long-term expensive contracts with Coca-Cola and have them now use your product. That's not an easy change for these companies to make, which is what makes Coca-Cola a harder company to displace. You can compare that moat that Coca-Cola has with something like Hollister or Abercrombie & Fitch, some of these more trendy clothing brands where people might love your products for a year or a few years and then they grow out of it. Or the next generation of teenagers come in and they don't like your products. There's no secret formula to calculate what a company's moat is, but some of the things that you want to look at are brand loyalty and how hard is it for a company to sell their products instead of yours. So when we talk about brand loyalty, how dedicated are people to buying your product or somebody else's? Is it just a commodity, or do people actually like this name, your brand's name, and they're willing to pay a premium for that brand name versus somebody else's? And how hard is it for somebody to go and buy somebody else's product instead of yours? Like with the Coca-Cola example, if you go to a movie theater that's selling Coca-Cola products, you're not gonna be able to go there and buy Pepsi. You're gonna have to buy Coca-Cola unless the theater cancels their contract with Coca-Cola, and that's not very easy to do. Third, you have to quote, ignore the chatter. This is a direct quote from Warren Buffett when he talks about trying to find stocks and not getting influenced by the day-to-day stuff that's going on, because the media is in the business of selling hype. They're in the business of selling emotion. But if you want to be an investor, especially a long-term investor, emotion is the enemy of your profits. The article says day-to-day events should not dictate your long-term investing strategy. Warren Buffett says, quote, I watch everything, but I don't do it to make specific investment decisions. I want to know what's going on, but I also don't think that I can make money by predicting what's going to happen next week or next month. I do think I can make money by predicting what's going to happen in 10 years. Anytime you turn on the financial news, you're going to see one of two things. You're going to hear that the world is ending, or the world is seeing the best economic growth than we've ever seen. But the reality, and something that you want to remember, is things are usually never as bad as the media makes it seem, and things are also never as good as the media makes it seem. So what you want to do is you want to cut through the noise, read the financials, not just the emotions, and understand what's going on and not get emotional. Make your investment decisions based on what you want to do for the long term and things that you believe in, and don't get emotional. Don't start panic buying and don't start panic selling just because you hear the media start hyping something up, good or bad. Warren Buffett is not a trader. When he invests his money into a company, he plans on owning it forever, or at least for many years. And so when he invests his money, he's thinking about the long term. He's not thinking about next week or next month or even next year. He's thinking decades down the road, and that's the type of decisions that he makes when he invests his money. Now, if you are a trader, then you're paying attention to emotion because you're trying to find a company where there's a lot of momentum behind it, and then you can get into this company while the momentum is there and then ride the company up. Warren Buffett doesn't believe in trading, so this is where you have to decide for yourself what's right for you and what is the right strategy for you. If you want to be a long-term investor, then you have to understand what does it mean to be a long-term investor. If you want to be a trader, then you have to understand what does it mean to be a trader. So the first thing you got to do before you do anything else is you have to know your stock market strategy and what your stock market goals are. Trading gives you the opportunity to make a whole lot more money today, but it also comes with a whole lot more risk. Investing doesn't come with the opportunity to make a whole lot more money today or tomorrow, but it comes with less risk. Now, before we move on to number 4, I do want to let you know that if you are interested in learning more about stock market investing and different types of stock market investing strategies and how you can build wealth in the stock market, our team put together an amazing guide on how you can start investing your money in the stock market even if you're a beginner. This guide to investing your money in the stock market is completely free, and it'll walk you through different stock market investing strategy. So if you want to read this free stock market investing guide, I'll put the link to how you can do that and join our free newsletter in the description below. The 4th tip by Warren Buffett is invest in stocks as you would a farm. Now this is again a direct quote from Warren Buffett where he talks about when you make your investment decisions, don't just think of your companies as stocks, think of them like a business that you're owning, or better yet, Think of them like a farm. So to help you understand what this means, let me just read you what Warren Buffett said because I think he can explain it better than I can. Changing your perspective on investing can help you focus on the long term. Quote, nobody buys a farm based on whether they think it's going to rain next year. They buy it because they think it's a good investment over 10 to 20 years. The problem is because investors can, quote, make decisions every second with stocks as opposed to owning a physical entity like stores or farms. They think an investment in stocks is different than an investment in a business, but it isn't. It's a lot easier to be emotional as an investor or a trader when you're buying stocks because you can see the price of your investment fluctuate day to day, minute to minute, second by second. I mean, if you compare this to buying real estate, kind of like what he talked about with a farm, you invest in real estate for the cash flow because you want to get that cash flow from the property that you own, and you're not paying attention to what's happening to property values every single minute or every single day because there's no way for you to check that. With the stock market is different. You can see the price of your investment fluctuate every single day, and if you buy something today and you see it go down by 2% tomorrow, and you can get panicky and you can get really emotional, and it can make you want to sell your stock even if your stock is a good investment because you're thinking of your stocks as stocks and you're not thinking of them as a business because a business takes time to grow and to generate more profits and to really see this growth in the stock price. This goes back to really knowing your goals because when Warren Buffett invests in a company, he knows that he's making this investment for the long term, and this is something that you have to sell to yourself too because if you really want to be an investor, you want to find a company that you believe in, that you believe will have value for the long term, that you want to own forever, and then you want to own it and then let whatever happen between now and then. If something major happens and now your company starts to hurt, where your company is no longer producing good products or people don't like this company's products before, that's different. But if you have other stock market fluctuations happening and this is affecting the price of your stock, you don't want to let that affect you. If anything, you just want to come in and buy more if the price of your stock goes more on discount if you believe in the value of your company. And the fifth tip by Warren Buffett goes to people who want to just invest their money in the market without spending all their time researching companies, researching stocks, keeping up with the valuation of companies and reading earnings statements. What he says is, quote, keep your costs down. If you want to invest your money in the market and you don't want to try to find the perfect companies to invest in, you have a few options. You can invest in ETFs. You can invest in index funds, and you can invest in mutual funds. What Warren Buffett says is that you can get a great return just by investing your money in the market and letting the market do its thing. On average, these money managers who you're paying to now manage your money are not going to be able to beat the market consistently. Sure, some can, but most are not going to be able to do that. So what he's saying here is instead of you going out and overpaying a money manager in a mutual fund to manage your money actively, where now not only are they going to have to get the average market return, but they're going to have to beat the return by the amount of the fee that they're charging you, which is not easy for them to do, especially doing that consistently year after year after year. How about you just invest your money into something like an index fund where now you're just getting exposure to the market and your fees on the index fund are significantly less than your fees to pay a money manager because your index fund is just managed by a computer. This index fund is just giving you exposure to the stock market. You go out and you can buy shares of an index fund, and when you do that, you get exposure to the general stock market. If the stock market goes up, your index fund will generally go up. If the stock market goes down, your index fund will generally go down too. Versus with the money manager or a mutual fund, now you're paying somebody to hopefully beat the market. And sure, maybe they can do that some years, but there's no guarantee that they're going to be able to do that year after year after year. And there's no guarantee that they're going to be able to beat the market return over a certain period of time. That's why Warren Buffett says, quote, in my view, for most people, the best thing to do is just to own the S&P 500 index fund. Warren Buffett even believes that his wife will get the best return with an index fund strategy too. He says, quote, she'll do fine with that. Anybody will do fine with that. It's low cost and it's in a bunch of wonderful businesses and it takes care of itself. Index funds and ETFs are an easy way for anyone to invest their money in the stock market, even if they don't understand how the stock market works, because now essentially you're just investing your money in the market. If the market goes up, you win. If it goes down, you don't. But this is an easy way for you to just start investing your money in the market without worrying about somebody eating away all your profits with fees. Thank you for watching. If you enjoyed this video, here's a video on how to build wealth that I think you'll love, and while you're at it, download our free stock market investing guide, and as always, keep hustling. You gotta stop hating people for becoming wealthy and understand the game and win at the game. Now, if you don't like the system, then what you should do is become wealthy and then use your wealth to give back and help other people. That's a good thing, and now you can inspire other people to do that.